my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for May 2023. Now, during our last update at the start of April, we noted that although rates had been fantastic during the first quarter of the year, there could be some seasonal and near-term headwinds that could pull rates back during the second quarter. And that has been the case at the start of Q2. We've seen rates come off during the course of April. But I think it's important to put these rates into context. Although the rates have come off a little bit from the highs of Q1, they're still very firm on a historical basis, and it's very natural in a tight tanker market to see some volatility in rates, with rates fluctuating from week to week and month to month. Encouragingly as well, at the start of May here, just in the last week or two, we've seen Aframax and Suezmax rates turn again and go back on a rising trend, even though VLCC rates have been a bit softer, with the onset of fresh OPEC supply cuts and some refinery maintenance in Asia. So why have the Aframax and Suezmax markets been so strong through the first few months of the year? Well, it's still a ton-mile story for the mid-sized tankers, particularly due to strong crude oil exports out of Russia and the US Gulf. So starting with Russia, we've seen that crude oil exports through the first 4 months of this year have averaged about 3.6 million barrels a day, which is up by about 500,000 barrels a day compared to Q4 of last year. And furthermore, all of these volumes now coming out of Russia, or I should say about 90% of these volumes, are flowing to India and China. So that's soaking up a lot of ton miles, not just for the ships that are doing those Russian trades. And just as a reminder, TNK does not transport Russian oil, but that trade is soaking up such a large number of ships that it's tightened supply for the whole market and caused rates to lift across the board. So we're continuing to see very high levels of Russian crude oil exports, even though the Russian government announced a 500,000 barrel a day supply cut from March. We're not really seeing that translate into lower crude oil exports, which suggests that it's probably more going into less oil going into their domestic refineries and less product output, and the crude exports seem to be being maintained. So that's very positive for Aframax and Suezmax ton-mile demand. Crude oil exports out of the US Gulf have also been very high. They've been averaging over 4 million barrels a day since the start of the year, with some weeks averaging over 5 million barrels per day. And that's been positive for mid-sized tankers because the oil that's moving directly from the US Gulf to Europe is mostly being done on Aframaxes and Suezmaxes. And then we have seen an increase in demand for Aframax lightering as well to parcel up volumes to a VLCC for onward transportation to Asia. Now, looking through to the rest of the year, we do expect quite strong oil demand growth through the remainder of the year. In fact, the IEA just came out with its new oil market report today, and it increased its oil demand growth forecast for 2023 by 0.2 million barrels a day to 2.2 million barrels a day, which will take total oil demand to about 102 million barrels a day this year, which will be a record high. And most of that growth is being driven by the non-OECD, and in particular China. So China is expected to account for about 60% of all oil demand growth this year, due to the post-COVID rebound that we're seeing there now that the travel restrictions have been eased. And the data during Q1 that we've seen in terms of travel and oil demand in China have been very positive, with oil demand hitting a record high of 16 million barrels a day during March. Now, there are some seasonal and short-term headwinds on the horizon. Again, first of all, the OPEC plus supply cuts of 1.16 million barrels a day have come into effect as of May 1st, and that's leading to a reduction in cargoes out of the Middle East. So that means less seaborne crude oil volumes, but it's mostly impacting the VLCC market, which is why I think we've seen the VLCC rates come off more than the Aframax and Suezmax rates recently. And in addition, I think with those OPEC supply cuts, what we'll probably see as well is it's going to cause a more rapid drawdown in global oil inventories during the second half of the year than we previously anticipated. So that means by the end of the year, there might be a need for OPEC to start returning supply to the market. So it could cause some weakness during the summer, but it might set us up for a stronger winter tanker market. Secondly, there are some concerns over the global economy. So there's still concerns about, core inflation, which remains stubbornly high, and rising interest rates to tackle that inflation. There's also been recent worries about the US banking system and the debt ceiling, all of which could contribute to a slowdown in the global economy over the next few months. And if it was a severe slowdown, if we see a severe financial crisis, that could have a meaningful impact on oil demand and tanker demand. Although that isn't our base case. Our base case obviously is for a moderating global economy, but that wasn't really expected to be the driver of global oil demand growth this year anyway. As I said previously, the main driver of demand growth this year is the post-COVID rebound in China and the taking away of the travel restrictions, rather than a very firm global economy. So I think even with a bit of a softening in the global economy over the coming months, it shouldn't make too much of a dent in oil demand. So for that reason, we think that Aframax and Suezmax spot rates will remain fairly well supported through the remainder of the year, albeit with some seasonality and quite high levels of volatility. So as I said, you'll probably see rates fluctuate quite a bit from week to week and month to month, but overall we think they'll stay relatively firm. Looking further ahead, the fleet supply fundamentals still look very positive. The order book, when measured as a percentage of the existing fleet, is still hovering around 4%, which is near record lows. And forward order book cover at the shipyards is very high as well, so most shipyards are now booked through till 2026. There has been an increase in ordering since the start of the year, particularly in the mid-sized sectors. So we've seen around 35 Aframax and LR2 orders since the start of the year, and about 20 Suezmax orders. And some of those orders have soaked up the remaining 2025 delivery berths at the shipyards. But for the most part now, those orders are coming into 2026. So for the next 2.5 years, the order book is pretty much locked in now, which gives us confidence that fleet growth will be very low over the next 2 to 3 years. So we're forecasting about 2% fleet growth this year, and then negligible levels of fleet growth over the 2024 and 2025. I think with these new orders as well, it's worth putting them into some context in terms of the size of the order book versus the fleet of aging ships that will need replacing in the coming years. And just to give some context on that, there are about 300 mid-sized tankers, so Aframaxes and Suezmaxes, which are due to turn age 20 between now and 2026, versus an order book of about 150 vessels. So we're still not too worried about the fleet growth side of things. Even with the increase in orders, it's still not enough really to replace the fleet of aging ships that are going to need replacing in the coming years. So that again gives us confidence in the medium-term fleet supply fundamentals. So taking all that together, I think we remain confident that the tanker market will be firm this year, but we're also confident that the tanker market has a good chance of a multi-year upturn here. Given the very low levels of fleet growth, we do expect that tanker demand is going to outweigh tanker fleet supply over the next 2 to 3 years, and that's going to give us a firm tanker market over the medium term. So that's our tanker market update for May 2023, and we'll speak to you again next month.